In March of 2021, one single trading firm lost $20 billion. This capital evaporated in exactly 48 hours, leaving the entire financial industry demanding to know how a loss of this magnitude was even possible. Bill Hwang was an elite Wall Street veteran. He was a tiger cub who trained at Tiger Management, one of the most respected hedge funds in history. He operated with billions of dollars, immense institutional backing, and decades of professional experience. Yet his empire collapsed anyway. His downfall was not caused by ignorance or a lack of preparation. He fell victim to a relentless, multi-year winning streak. When a retail trader blows up a $500 account after a few lucky trades, we blame greed. When a professional blows up $20 billion, the emotional trigger is the same. The scale is different, but the psychology is identical. Prolonged success creates a dangerous psychological vacuum. As the account balance grows, the trader stops feeling the inherent danger of the market. The moment the fear of losing disappears, they unknowingly prepare for their own destruction. Hwang spent his early career navigating the highest levels of institutional finance. Over the years, he endured massive market swings and survived harsh regulatory penalties. He learned how to take a heavy hit and stay in the game. That history of survival plants a deadly psychological seed. Navigating financial disasters and repeatedly bouncing back creates an internal belief that you can always recover from a bad position. Psychologists call it overconfidence bias. For a trader, it is a terminal illness. As Hwang's fund, Archegos, built its massive winning streak, that confidence compounded. When a trader wins repeatedly, their thought process shifts. They stop thinking in terms of statistical probabilities and mistake a temporary hot streak for permanent genius. This is reinforcement learning in action. With every successive win, the brain is flooded with dopamine. The nervous system is chemically rewarded for taking on risk until it becomes addicted to that sensation. The wins literally rewire the trader's behavior. The true danger of a winning streak is the illusion of control. The false belief that because you understood the market's past movements, you have absolute authority over its future. To execute his vision, Hwang relied on total return swaps. These allowed him to control enormous positions using borrowed money while hiding his actual exposure from the banks. He turned roughly $10 billion of firm capital into over $100 billion of market exposure. Leverage behaves more like a stimulant than a mathematical tool. It takes baseline emotions and cranks them up, magnifying fear, greed, and euphoria until rational thought collapses. Hwang's ego became inseparable from his trades. Because selling would have felt like admitting defeat, he placed massive, concentrated bets on a handful of media and tech stocks. He was no longer managing risk, he was defending his beliefs. In March of 2021, one of those core holdings, Viacom CBS, announced a stock offering. The share price dropped. Because Hwang's portfolio was stretched to its limit, that single dip triggered immediate margin pressure. The banks realized how overexposed Archegos actually was. Panic set in. Lenders demanded immediate collateral to cover the dropping value of the swaps, and when Hwang could not pay, they turned on him. A brutal, forced liquidation began. The banks dumped billions of dollars of Hwang's stock into the market in a massive fire sale. Over 48 hours, the prices plummeted, and $20 billion of wealth vanished. The margin call was simply the mechanical execution of the firm. The actual collapse started months earlier. The moment's success removed Hwang's humility. Amateurs define risk by the potential for financial loss. Professional risk management focuses on psychological preservation, prioritizing the trader's mental state as much as their bank account. True risk is emotional destabilization. If a position is large enough to overload your nervous system with anxiety, your intelligence no longer matters. You will panic, ignore your process, and make the wrong decision. To survive in the market, you must follow strict psychological boundaries. You must learn to fear a winning streak more than a losing streak. Your identity as a trader should be built around executing your process perfectly, rather than the profits you generate. You must use position sizing to keep your emotions neutral and actively train to survive the intoxicating effects of success. Real discipline is staying grounded when your profits tell you that you're a genius. Bill Hwang had immense access, intelligence, and resources. He didn't fail because he was weak.
He failed because constant success convinced him that he was immune to the laws of risk. The market does not destroy traders when they are paralyzed by fear. It destroys them the moment they stop being afraid.
Becoming a profitable trader isn't about the next setup. It's about becoming the person who can follow it. Subscribe for your regular bite of wisdom. Train the mind, the trades will follow.